There is a lie that has been sold to you. It's a seductive, powerful lie, whispered in the breathless tones of market commentators and splashed across the headlines of financial news networks. It's the lie that growth, in and of itself, is the ultimate good. That a company whose sales are rocketing upward is an automatic ticket to wealth. That the faster the revenues climb, the more you should be willing to pay for a piece of the action. This idea is so deeply embedded in the culture of investing that to question it seems like heresy. We are conditioned to chase it, to celebrate it, to pay any price for it. But Warren Buffett, the man who built a $100 billion fortune on the bedrock of cold, hard business logic, knows the truth. He knows that this obsession with fast growth is one of the most dangerous traps in the entire financial world. It is a siren song that has lured countless investors onto the rocks of financial ruin. He knows that some companies, the fastest-growing ones, the darlings of Wall Street, are actually financial black holes. They are businesses that grow by consuming their owners' money, requiring so much fuel to power their ascent that they leave nothing behind but smoke and disillusionment. They are engines of value destruction disguised as rockets of progress. What you are about to learn is the critical distinction that separates the amateur from the professional, the speculator from the owner. It is the mental model that allows you to look at two companies, one growing at 25% and another at 5%, and know with confidence why the slower grower might be the vastly superior investment. This is not about being a Scrooge or being afraid of progress. It is about becoming a critical analyst of growth itself. It is about learning to differentiate between the good, profitable growth that builds generational wealth and the bad, value-destroying growth that drains your savings and breaks your financial promises. The principle is this. The growth trap occurs when a company's rapid expansion requires so much capital that it actually produces poor or even negative returns for its shareholders. The mistake it prevents is automatically paying a premium for any company with a rising revenue line, without first doing the crucial work of determining if that growth is actually creating any value for you, the owner. The transformation you will undergo is profound. You will learn to see past the headlines, to ignore the hype, and to analyze a business with the clear, unforgiving eyes of a proprietor. You will save yourself from one of the market's most seductive and costly traps, and in doing so, you will take a monumental step toward true financial freedom and mastery of your own investment strategy. We begin with the foundational pillar, the very heart of this dangerous paradox. It is the concept that growth is not free. It has a cost. And sometimes, that cost is catastrophically high. This is the pillar we call the capital hunger of growth, understanding the engine that consumes value. To truly grasp this, we must travel back in time, not to a story of a soaring tech stock or a Wall Street triumph, but to a place of grinding gears, deafening looms, and the slow, inevitable death of an American industry. We must go to New Bedford, Massachusetts in the mid-1960s, to a textile mill named Berkshire Hathaway. This is not the Berkshire Hathaway you know today, the sprawling conglomerate and monument to intelligent capital allocation. This was the original Berkshire, a failing textile business that Warren Buffett found himself in control of, and it would become the most important and most painful business lesson of his life. The anecdote begins in 1962, when Buffett began buying shares of the company. He saw it as a classic cigar butt investment, a troubled company trading for so little that there was one last puff of profit left in it for a savvy investor. By 1965, after a dispute with the management, he had taken control, and he found himself at the helm of a business in a truly terrible industry. The American textile business was a brutal, unforgiving landscape. The competition wasn't just from other mills in New England, it was from non-union shops in the South, and, increasingly, from low-cost producers overseas. It was a commodity business, meaning the only thing that differentiated one company's bolts of cloth from another's was price. This created a relentless, downward pressure on profits. But here is where the growth trap revealed its teeth. The CEO of Berkshire, a man named Ken Chase, would come to Buffett each year with a budget for capital expenditures. He would explain, with perfect logic, that their looms were getting old. Competitors were installing newer, faster, more efficient machines. To simply stay in the game, to maintain their meager market share and produce cloth at a price that wasn't embarrassingly high, Berkshire had to spend millions of dollars on new equipment. In 1967 alone, the company spent over $800,000 on capital improvements, a significant sum for a business of its size. From the outside, this looked like progress. It looked like growth. The company was investing in itself, modernizing and fighting to compete. But Buffett saw the terrifying reality. All this spending, all this investment, all this growth was doing nothing to improve their fundamental economic position. They were spending millions just to run in place. Imagine a hamster on a wheel. It can run faster and faster, expending enormous energy, but it never actually goes anywhere. That was the Berkshire Hathaway textile business. They would spend $1 million on new looms, and for a short time, their costs would go down. But then their competitors would buy even newer looms, or a new factory would open in South Carolina, and all of those gains would be competed away. The return on that huge capital investment was effectively zero. Buffett later described it with brutal clarity. He said the business earned pathetic returns and required constant infusions of cash. Let's quantify that. For the entire period that Buffett ran the textile operation, from the mid-60s to its eventual closure in 1985, the business consumed immense amounts of capital. The money spent on new machinery, on maintaining the sprawling old factories, on inventory that was constantly falling in value. It was a financial quagmire. That money, if it had been invested in almost anything else, would have compounded into a fortune. Instead, it was incinerated in the furnace of a terrible industry, all in the name of staying competitive and achieving what looked, on the surface, like a form of growth. The final, painful decision came in 1985. After nearly 2 decades of struggle, of pouring good money after bad, Buffett shut the whole operation down. He had learned the hard way that you cannot turn a fundamentally bad business into a good one, no matter how much capital you pour into it. He learned that some businesses are so capital-intensive, their appetite for cash is so voracious, that they are incapable of creating real value for their owners. This experience was the crucible that forged his entire philosophy. It taught him that the first question an investor must ask is not, "Is this business growing?" but "How much capital does it take to generate that growth?" The ghost of that New Bedford mill, with its insatiable hunger for new looms that produced no lasting return, haunts every investment decision he has made since. It is the foundational story that explains why he would rather own a business growing at a modest rate that requires no capital than a business with explosive growth that consumes every dollar it earns and more. This painful, expensive lesson became the bedrock of his approach to wealth building and risk management. The reason this trap is so effective, why so many people fall for it, is rooted deep in our cognitive wiring. The underlying psychological principle at play is a potent combination of the action bias and the illusion of control. The action bias is our innate tendency to favor action over inaction, even when inaction is the more rational choice. We are wired to believe that doing something is better than doing nothing. In the world of investing and corporate management, this bias is rampant. A CEO who announces a massive new factory, a billion-dollar expansion plan, or an aggressive push into a new market is lauded as a visionary, a dynamic leader. They are asterisks doing something. Analysts applaud the bold moves, and investors get excited about the visible signs of progress. The stock price often rises in response to the announcement of these capital-heavy projects. We see the cranes, we read the press releases, we hear about the revenue growth to come, and our brain interprets this activity as progress, as value creation. It feels good. It feels productive. In contrast, a CEO who says, "Our industry is tough, so we are not going to expand this year. Instead, we're going to pay out our profits as a dividend or buy back stock," can be seen as passive, uninspired, or lacking a vision for growth. The action bias makes us mistake movement for achievement. The Berkshire Hathaway textile mill was a flurry of activity. New looms being installed, workers running 3 shifts, trucks shipping out cloth. It looked like a productive enterprise, but economically it was a slow-motion liquidation. Compounding this is the illusion of control. This is the cognitive bias where we overestimate our ability to control events. For a CEO, the belief that they can outsmart a fundamentally bad industry through sheer effort and investment is a powerful one. They believe that their new factory will be the one that finally achieves sustainable profits, that their management skill will be enough to overcome brutal industry economics. They have control over the decision to spend the money, so they falsely believe they can control the outcome of that spending. Investors fall for the same illusion. We believe that by picking a company that is visibly growing and investing, we are making a smart, proactive choice. We feel in control of our financial destiny because we are backing a horse that is clearly running hard. The problem is that in a capital-intensive, low-return industry, neither the CEO nor the investor has control over the most important factor, the industry's fundamental structure. No matter how brilliantly Ken Chase ran the Berkshire Mill, he could not control the fact that someone in another state could always make cloth a little bit cheaper. He was not in control of the ultimate return that his capital investments would generate. This psychological cocktail is why the growth trap is so potent. It appeals to our desire for action and our belief in our own agency. We see growth, we see investment, and we think good. Our brains are not naturally wired to perform the second, more difficult step, calculating the return on that investment and questioning whether the action is truly productive. Buffett's genius is his ability to suppress this bias. He has trained himself to be comfortable with inaction and to be brutally honest about where he does and does not have control. He would rather sit on a pile of cash for years than deploy it into an active, exciting, but ultimately value-destroying enterprise. So how can we, as retail investors, translate this powerful lesson into a practical tool? We need an applied mental model, a blueprint we can use to perform our own due diligence and avoid the capital-hungry beasts. Let's call it the capital intensity test. It's a simple, 3-step process to diagnose the capital appetite of any business you're analyzing. Step 1 is to measure the historical capital expenditure burden. Go to the company's cash flow statement for the last 5 to 10 years. Find the line item called capital expenditures or purchases of property, plant, and equipment. Now compare this number to the company's total revenue for each of those years. Calculate CapEx as a percentage of sales. Is it consistently low, say under 5%? Or is it consistently high, perhaps 10, 15, or even 20%? A company that has to spend 15 cents of every dollar of sales just to maintain and grow its operations has a very different economic reality than one that only has to spend 2 cents. This simple ratio immediately tells you how much of the company's cash is being consumed by the beast of its own operations. Think of airlines, which have to spend fortunes on new planes, or semiconductor manufacturers building multi-billion-dollar fabs. Their CapEx as a percentage of sales is enormous. This is your first red flag. Step 2 is to analyze the working capital requirements. This is a bit more subtle but just as important. Working capital is essentially the money a business needs to tie up in its day-to-day operations. Things like inventory and accounts receivable. Some businesses require huge amounts of additional working capital to grow. For example, a fast-growing retail company has to constantly buy more inventory to stock its new stores. That's cash that gets tied up on the shelves, cash that cannot be returned to shareholders. To find this, look at the balance sheet over the past few years. Look at the change in non-cash working capital, usually accounts receivable plus inventory minus accounts payable. If a company's sales grow by $100 million, but its inventory and receivables have to grow by $40 million to support that growth, that's $40 million of cash that has been consumed by the growth. It's another hungry mouth to feed. Step 3 is the crucial synthesis. Compare the total capital consumed to the profit generated. Add the capital expenditures from Step 1 to the investment in working capital from Step 2. This gives you the total growth capital the company has deployed over a period, say 5 years. Now, look at how much the company's operating profit has grown over that same period. Let's say a company spent a combined $500 million in CapEx and increased working capital over 5 years. And during that time, its operating profit grew by $50 million. This means it had to invest $10 of cold, hard cash to generate $1 extra of annual profit. That is a 10% return on incremental capital, which might be okay, but it's certainly not spectacular. What if it had to invest $1 billion to get that same $50 million in extra profit? That's a 5% return, which is likely value destructive. This simple framework forces you to answer the question Buffett learned in the textile mill. For every dollar we put into this business, how much do we get back out, and when? It moves your stock analysis from a passive observation of revenue growth to an active investigation of capital efficiency. It's the blueprint that protects you from falling for the illusion of action and helps you identify businesses that truly gush cash for their owners. To fully appreciate the wisdom of this approach, we must examine its opposite. We must walk the path of the 99%, the path of the average investor who consistently falls for the growth trap. This is the world of the antithesis, and its poster child is the airline industry. For decades, the airline industry has been a perfect storm of the worst possible business characteristics, a fact Warren Buffett and Charlie Munger have pointed out with grim humor time and time again. Let's deconstruct why it represents the path of failure. First, it is an industry with astronomical capital intensity. An airline's primary assets are airplanes, which cost hundreds of millions of dollars each. They have a limited lifespan and require constant, expensive maintenance. To grow, an airline must buy more of these fantastically expensive assets. The capital expenditures are simply breathtaking. This immediately fails the first step of our capital intensity test. The 99% investor sees an airline announce a massive order for new Boeing or Airbus jets and thinks, "Great, they're expanding their routes, growing their fleet." This is a growth story. The Buffett-trained analyst sees the same announcement and shudders, calculating the billions of dollars in capital that will be consumed and wondering what the return on that capital could possibly be. Second, the industry is fiercely competitive and largely commoditized. While people may have a preferred airline, for most travelers, the primary decision factor is price. This leads to endless, value-destroying price wars. One airline lowers fares to fill seats, and the others are immediately forced to match, erasing any potential profit. There is no sustainable competitive advantage, no moat. This means that even after spending billions on new, more fuel-efficient planes to lower their costs, those cost savings are not kept as profit for the shareholders. They are immediately passed on to consumers in the form of lower ticket prices, simply to stay competitive. The benefits of the massive capital investment are competed away. The 99% investor focuses on rising passenger numbers, a revenue metric, ignoring the collapsing profit margins per passenger. Third, the industry has high fixed costs and is incredibly sensitive to external factors beyond its control. Labor costs, often governed by powerful unions, are high, and the biggest variable, jet fuel, can swing wildly in price, turning a profitable quarter into a disastrous one overnight. The average investor ignores this operational leverage, getting excited during the good times when fuel is cheap and demand is high, only to be wiped out when the cycle inevitably turns. The combination of these factors creates a business that, over the long term, has destroyed far more capital than it has created. Buffett famously joked that if a capitalist had been present at Kitty Hawk, he should have shot Orville right down. He has calculated that from the dawn of aviation through the early 2000s, the net aggregate earnings of the entire U.S. airline industry were negative. Billions upon billions of dollars of investor capital had been poured into this growth industry, and the net result was a loss. This is the ultimate antithesis. It's an industry that is constantly growing, more passengers, more routes, more planes, but it does so by consuming capital at a ferocious rate and earning pathetic returns on that capital. The 99% chase the story of growth and expansion, while the disciplined analyst sees the economic reality and stays far, far away. So how does this principle, this discipline of avoiding capital-hungry businesses, manifest directly on a company's financial statements and in your portfolio? The direct financial connection is most clearly seen in a metric that Buffett considers the holy grail: free cash flow. Free cash flow, in its simplest form, is the cash a company generates from its operations minus the capital expenditures needed to maintain and grow the business. It is the pool of money that is truly free to be returned to the owners of the business, either through dividends, share buybacks, or to be reinvested in genuinely high-return projects. A company caught in the growth trap, like the old Berkshire textile mill or a struggling airline, will have chronically low or even negative free cash flow. Look at their cash flow statement. You might see a healthy number for cash from operations. But then you look down a few lines to capital expenditures, and you see a massive negative number that eats up all, or even more than, the operating cash. This company, despite potentially reporting a profit on its income statement, thanks to accounting conventions like depreciation, is not actually generating any surplus cash for its owners. It is a cash incinerator. Its growth is a mirage, funded by either taking on more debt or by issuing more shares and diluting the existing owners. This is the mathematical signature of value destruction. In stark contrast, a capital-light business, the kind Buffett loves, is a free cash flow machine. Think of a company like See's Candies, one of Berkshire's most successful investments. To open a new store, See's needs a modest amount for rent, display cases, and inventory. The capital required to grow is minimal, but the brand allows them to charge a premium price, so the profits from that new store are substantial. The result is that the vast majority of See's operating cash flow converts directly into free cash flow. That cash then flows up to Berkshire Hathaway's headquarters in Omaha, where Buffett can allocate it to other attractive investments. This is how real wealth is built. The direct financial connection for you, the investor, is profound. A portfolio filled with companies that gush free cash flow is a portfolio that will grow in value through multiple avenues. These companies can consistently raise their dividends, providing you with a direct cash return. They can aggressively buy back their own stock, which makes your ownership stake in the company more valuable. Or, if they are truly exceptional, they can reinvest that cash at very high rates of return, compounding your capital internally at a rapid pace. A portfolio filled with companies from the antithesis column, the capital guzzlers, is a portfolio on a treadmill. These companies are constantly in need of more money. They rarely pay significant dividends because they need every penny for CapEx. They often dilute their shareholders by issuing new stock to fund their growth plans. Your ownership stake gets smaller, and you rarely see a cash return. The difference in your long-term wealth building is the difference between an overflowing reservoir and a bucket with a hole in it. By mastering the analysis of capital intensity, you are learning to choose the reservoirs, ensuring that the companies you own are not just growing, but growing in a way that makes you, the owner, richer. Now that we understand the fundamental danger of capital-hungry growth, we must confront the second great illusion that fuels this trap. It is the market's obsessive, myopic focus on a single number. A number that tells you almost nothing about the true quality of a business. This brings us to our second pillar, the siren song of revenue, why top-line growth is Wall Street's most dangerous illusion. Revenue, or sales, is the easiest metric to understand and the simplest to get excited about. When a company reports that its revenues grew by 30% year over year, it makes for a great headline. It sounds dynamic, successful, and exciting. The financial media trumpets the number, analysts revise their models, and investors, caught in the fervor, rush to buy the stock. This top-line figure is a powerful narrative device, but it is often a deeply misleading one. It is a siren song, a beautiful and alluring melody that hides the treacherous rocks of poor profitability and value destruction just beneath the surface. To understand the tragic power of this illusion, we must revisit one of the most infamous periods of market history, the dot-com bubble of the late 1990s. This was an era when the siren song of revenue reached a deafening crescendo, and an entire generation of investors was dashed upon the rocks. Our foundational anecdote for this pillar centers on a company that became the symbol of this mania, Webvan. Founded in 1996, Webvan had a grand and seemingly brilliant vision to revolutionize the grocery business by allowing customers to order groceries online and have them delivered to their door within a 30-minute window of their choosing. The story was incredible. It was the future. They were going to disrupt a multi-hundred-billion-dollar industry, and on the surface, their growth was absolutely explosive. In late 1999, the company went public. In its IPO prospectus, it showed staggering revenue growth, going from virtually nothing to millions of dollars in sales in a very short period. Wall Street was utterly captivated. The narrative was all that mattered. The company was building massive, state-of-the-art automated warehouses that cost over $30 million each. They were buying fleets of custom-designed delivery trucks. They were hiring thousands of employees. They were expanding to city after city. And their revenues were soaring as more people tried the service. On the day of its IPO in November 1999, Webvan's stock price exploded, giving the company a market capitalization of over $8 billion, more than the established profitable grocery giants like Kroger that had been in business for decades. But beneath the beautiful song of revenue growth was a horrifying economic reality. For every dollar of revenue Webvan was bringing in, it was spending far more than $1 to generate it. The cost of the massive warehouses, the sophisticated logistics software, the fleet of trucks, the drivers, the marketing to acquire each new customer. It was a financial bonfire. Their income statement was a sea of red ink. In the year 2000, the company generated revenues of $178 million. A fantastic top-line number for a young company. But its cost of goods sold and operating expenses were a staggering $755 million. They lost nearly $600 million in a single year. But for a time, none of this mattered. The market was completely mesmerized by the revenue growth. The mantra of the era was, "Get big fast." The idea was to capture market share and eyeballs at any cost, with the vague promise that profitability would somehow, magically, appear in the future. Investors, from seasoned professionals to retail newcomers, were buying the story, not the business. They were listening to the siren song. The end, when it came, was swift and brutal. The company was burning through the cash it had raised in its IPO at a terrifying rate. By mid-2001, less than 2 years after its celebrated public offering, the money was gone. The company couldn't pay its suppliers or its employees. Webvan filed for bankruptcy, laying off its entire workforce and shutting down its operations. The stock, which had once been worth over $30 a share, was worthless. The $8 billion in market value had evaporated. Investors who had been seduced by the incredible revenue growth were completely wiped out. The Webvan story is the ultimate cautionary tale. It proves that revenue, in isolation, is a meaningless and often dangerous metric. Growth that comes at the cost of gargantuan losses is not growth at all. It is a rapid form of self-destruction. This period taught a painful lesson to those who were willing to learn. The top line is vanity. The bottom line is sanity, but cash flow is reality. Focusing only on the siren song of revenue is an investment strategy that leads directly to ruin. The psychological grip of revenue is so powerful because it taps into two of our most potent cognitive biases, the herd mentality and the narrative fallacy. Herd mentality is our deep-seated instinct to follow the crowd. In our evolutionary past, straying from the tribe was dangerous. Safety was in numbers. This instinct is still very much alive in financial markets. When a stock is soaring, when every analyst on television is singing its praises, when your friends are talking about how much money they're making on it, the pressure to join the herd is immense. The fear of missing out, or FOMO, becomes overwhelming. Revenue growth is the perfect fuel for this herd behavior. It's a simple, easy-to-understand number that everyone can point to as justification for why the stock is going up. Of course it's a good investment. Look at how fast their sales are growing. This becomes the social proof that validates the decision to buy, allowing us to suspend our critical thinking and just follow the stampede. No one wants to be the person standing on the sidelines while everyone else appears to be getting rich. Complementing this is the narrative fallacy, a term coined by Nassim Nicholas Taleb. This is our tendency to prefer simple, compelling stories over complex, messy realities. Our brains are story processors. We crave narratives that have a clear beginning, middle, and end, with heroes and villains and a grand purpose. A company with explosive revenue growth provides the perfect fodder for a great story. This company is disrupting an old industry. They are changing the way we live. They are building the future. These are powerful, emotionally resonant narratives. They are far more appealing than the boring, complicated story told by a full analysis of a company's financial statements. A detailed look at operating margins, return on capital, and cash flow conversion is complex and doesn't make for a good cocktail party story. The narrative of 30% revenue growth, however, is simple, exciting, and easy to repeat. The dot-com bubble was the peak of narrative-driven investing. The stories were about changing the world, and metrics like profitability were dismissed as old economy thinking. The narrative fallacy allows us to become emotionally invested in a stock, making it much harder to sell even when the evidence of a failing business model becomes overwhelming. We fall in love with the story, and the top-line revenue growth is the constant reassurance that our story is still on track. Buffett's method is the antidote to this. He deliberately ignores the narrative and the herd. His focus is on the cold, hard numbers that lie beneath the story, the boring but essential facts of profitability and cash generation. He is immune to the siren song because he has trained himself to listen only to the music of the financial statements. So how do we immunize ourselves? How do we build a practical defense against the allure of the top line? We need a mental model that forces us to connect revenue to actual value creation. Let's call this blueprint the profitability bridge. It's a structured way to walk down the income statement, analyzing the quality of the revenue at each step. Step 1. Start at the top with revenue. Acknowledge the growth. Is it 20%? Great. Now, immediately ask the most important question. What is the quality of this revenue? Is it from selling a product at a profit, or is it bought revenue, acquired through deep discounts and unsustainable marketing spend? Is it recurring subscription revenue or one-time, lumpy sales? Make a note of the growth rate, but hold your applause. Step 2. Cross the first part of the bridge by subtracting the cost of goods sold, COGS, to arrive at gross profit. Now, don't just look at the absolute number. Calculate the gross margin, gross profit divided by revenue. This is a crucial indicator of a company's pricing power and production efficiency. Here's the key. How is the gross margin trending over time? If a company is growing revenues by 20%, but its gross margin is falling from 60% to 50%, that is a massive red flag. It suggests they are cutting prices to achieve that growth, a classic sign of a weak competitive position. A strong business can grow while maintaining or even expanding its gross margins. Step 3. Continue across the bridge by subtracting selling, general, and administrative (SG&A) expenses. This gives you the operating profit, or EBIT, earnings before interest and taxes. Again, the key is the margin. Calculate the operating margin, operating profit divided by revenue. This tells you how efficient the core business is. A great sign is operating leverage, when revenues grow faster than SG&A, causing the operating margin to expand. This shows the business is scalable. A bad sign is when SG&A is growing just as fast or faster than revenue, meaning the company has to spend more and more to get each new dollar of sales. Step 4. Complete the journey by subtracting interest and taxes to arrive at net income, the famous bottom line. Calculate the net profit margin. This is the final measure of how much of each dollar of sales the company keeps for its owners. By walking through this process, you are forced to see the relationship between the top line and the bottom line. You build a bridge of logic from the headline number to the number that actually matters. The profitability bridge transforms you from a passive consumer of revenue headlines into an active analyst of business quality. A company growing revenues at 30% with shrinking margins at every level of the bridge is a disaster waiting to happen. A company growing revenues at a boring 8% but consistently expanding its margins is a potential wealth-building machine. This simple but powerful stock analysis tool will protect you from the siren song for the rest of your investing life. To truly cement this principle, let's examine the antithesis, the path of the 99% investor who is perpetually seduced by the revenue story. Picture a typical retail investor. Let's call him Tom. Tom gets a notification on his trading app. Shares of TechCorp Inc. are up 20% today. He taps on it. The headline reads, TechCorp announces 50% revenue growth, crushes expectations. Tom feels that familiar pang of FOMO. He pulls up the stock chart. It's a beautiful soaring line going up and to the right. He reads a few analyst comments. Paradigm shift, disruptive technology, massive addressable market. He sees the story, the narrative. Without any further due diligence, without looking at a single line of the company's income statement beyond the revenue number, he places a market order to buy 1,000 shares. For the first few days, he feels like a genius. The stock continues to drift higher on the positive sentiment. He checks his account multiple times a day, enjoying the green numbers. He is part of the herd and it feels great. But then, the next quarter's earnings report comes out. The company reports another impressive revenue growth number, say 40%. But the stock plummets 15%. Tom is confused and angry. But they beat on revenue. He fumes. He is forced to dig deeper. He pulls up the financial report for the first time and sees the ugly truth that was hiding in plain sight. Gross margins have collapsed because of price wars with a new competitor. SG&A expenses have ballooned, as the company spent a fortune on Super Bowl ads to acquire those new customers. The company's net loss has actually widened significantly. They are burning through cash at an alarming rate and announce they will need to sell more stock to fund their operations, diluting shareholders like Tom. The beautiful narrative has collided with the brutal reality of the profitability bridge. Over the next year, the excitement fades. The market realizes that the growth is unprofitable and unsustainable. The stock bleeds out, day after day, week after week. Tom, who bought at the peak of the hype, eventually sells for a 70% loss, swearing off the stock market as a rigged game. Tom's story is the story of millions. It is the path of the 99%. He did not engage in investment strategy. He engaged in emotional speculation. He mistook a compelling story for a compelling business. He mistook revenue for profit. He listened to the siren song and crashed his portfolio on the rocks. The disciplined investor, using the profitability bridge, would have seen the red flags from a mile away. They would have seen the deteriorating margins and the negative cash flow and concluded that the headline revenue number was a dangerous illusion. This discipline is not about being cynical. It is about being realistic. It is the shield that protects your capital from the market's most seductive narratives. The direct financial connection between focusing on quality revenue and your own financial success is clear and powerful. It all comes down to the income statement and what it reveals about a company's economic engine. Thinking of the income statement as just a report card with a final grade, net income, is a mistake. It is the schematic of a machine. Revenue is the fuel going in. The various costs, COGS, SG&A, are the friction and heat generated by the machine, and net income is the actual horsepower that comes out the other end. The 99% investor only looks at the amount of fuel being shoveled into the engine. The sophisticated investor, the one practicing sound business analysis, is obsessed with the engine's efficiency. How much of that fuel is being converted into useful power, and how much is being wasted as noise and heat? A company with high and stable margins is an efficient engine. It converts a large portion of its revenue into profit. A company with low or declining margins is an inefficient engine. It may burn a lot of fuel, high revenue growth, but it produces very little power, low or no profit. This has a direct and tangible impact on your portfolio growth. An efficient, high-margin company has options. Its profits can be reinvested to generate more profitable growth, they can be used to pay you a dividend, or they can be used to buy back shares. All of these actions directly increase the intrinsic value of your investment. An inefficient, low-margin company has no good options. It is in a constant struggle for survival. It has no spare cash to reward shareholders. Any money it does generate has to be immediately plowed back into the business just to stay alive. Often it has to seek external funding, which, as we've seen, dilutes your ownership. Over a 10-year period, owning a portfolio of financially efficient companies versus a portfolio of inefficient revenue growth companies will produce dramatically different results. The former will likely lead to substantial wealth building, powered by the compounding of profits. The latter is likely to lead to stagnation or significant loss, as the initial hype gives way to the relentless gravity of poor economics. By learning to read the income statement as a story of efficiency, not just a story of size, you fundamentally alter your stock-picking process. You stop chasing the hot story and start buying the great business. This shift is a cornerstone of financial literacy and is absolutely essential for anyone serious about using the stock market to achieve long-term financial goals. We've now established that growth can be a capital-devouring monster and that revenue by itself is a dangerously misleading metric. This begs the question, what then is the correct way to measure a business? If we are to think like Warren Buffett, we must adopt his perspective. We must stop thinking like stock traders who are renting a piece of paper and start thinking like proprietors who own the entire enterprise. This leads us to our third, and perhaps most crucial, pillar, the owner's yardstick, measuring growth with return on capital. The goal of a business, from the owner's perspective, is not to get bigger for the sake of getting bigger. The goal is to generate a satisfactory return on the capital that has been invested in the enterprise. A business is a machine for turning money into more money. The critical question is, how good is the machine? If you put $1 of your hard-earned capital into it, how many cents of profit does it spit out each year? This simple but profound concept is the ultimate measure of business quality, and it is the yardstick that Buffett uses to evaluate every investment he makes. The foundational anecdote that perfectly illustrates this principle is the story of one of the best businesses Buffett ever bought, See's Candies. In 1972, Buffett and Munger had the opportunity to buy the California-based chocolate company. The asking price was $30 million, but they managed to acquire it for $25 million. At the time, See's had about $8 million in tangible assets, things like factories and equipment. It was earning about $2 million a year after tax. A quick calculation shows that the business was earning a 25% return on its tangible assets, $2 million in earnings, /8 million in assets. This was a good business. But Munger in particular was hesitant. The company wasn't a statistical bargain, and it wasn't a fast-growing tech company. It was a simple regional candy business. Buffett, however, saw something deeper. He saw a business that possessed a powerful, though unstated, asset, a fantastic brand that commanded loyalty and pricing power. People in California loved See's Candies and were willing to pay a premium for it, especially during holidays like Christmas and Valentine's Day. This is where the owner's yardstick comes in. See's Candies had a remarkable characteristic. It could grow without requiring significant new capital. When they wanted to open a new store, the cost was minimal. They didn't need to build a new billion-dollar factory. They just needed a lease and some basic fixtures. More importantly, the business had what's called a negative working capital cycle. Customers paid for their candy up front, in cash. But See's didn't have to pay its suppliers for sugar and chocolate for 30 or 60 days. In effect, its customers and suppliers were funding its operations. The business generated cash before it had to pay its bills. The combination of high returns on existing assets and very low capital requirements for growth made See's a truly extraordinary economic machine. Over the years, See's grew its sales and, crucially, was able to consistently raise its prices, often ahead of inflation, without losing customers. This pricing power, a direct result of its brand, meant that profits grew steadily. And because the business didn't need to retain that profit for new capital expenditures, it could be sent back to Omaha as a dividend to Berkshire Hathaway. Let's look at the numbers, because they are staggering. Since being acquired for $25 million, See's Candies has generated over $2 billion in pre-tax earnings for Berkshire. That is a return of 80 times their initial investment, and the business is still owned by Berkshire and still generating cash. That $2 billion was money that Buffett could then use to buy other wonderful businesses, like Coca-Cola or American Express. See's became the prototype of the perfect Berkshire subsidiary, a business with a durable competitive advantage that requires little capital and produces high returns, gushing cash that can be redeployed elsewhere. The lesson is profound. See's Candies was never a fast growth story in the way Wall Street uses the term. It wasn't doubling sales every year, but its growth was of the highest possible quality. Every dollar of profit it generated required very little incremental capital investment. Its return on capital was, and remains, enormous. This is the owner's perspective in its purest form. It's not about the speed of growth. It's about the profitability and capital efficiency of that growth. A business earning 30% on capital is a far better place to have your money than a business earning 5%, even if the latter is growing its revenues twice as fast. See's Candies taught Buffett that it is far better to pay a fair price for a wonderful business than a wonderful price for a fair business. And the definition of a wonderful business is one that scores high on the owner's yardstick, return on invested capital. The reason most investors fail to use this superior yardstick is due to a powerful psychological bias called anchoring and adjustment. Anchoring is our tendency to rely too heavily on the first piece of information offered, the anchor, when making decisions. In investing, common anchors are simple, widely available metrics like the price-to-earnings (PE) ratio or the revenue growth rate. When we first analyze a company, our brain latches onto these simple numbers. We see a PE of 15 and think, cheap, or a PE of 40 and think, expensive. We see revenue growth of 25% and think, quote, fast grower. Our entire subsequent analysis is then colored by this initial anchor. We then adjust from that anchor, but our adjustments are often insufficient. We might acknowledge that the high-growth company has low margins, but we don't adjust our valuation enough to account for it because our mind is still anchored to the fast grower label. The concept of return on invested capital, ROIC, requires a deliberate effort to unanchor our thinking. It forces us to discard the simple surface-level metrics and ask a more fundamental, more powerful question. It is a cognitive shift. It's about changing the very frame of the analysis. Instead of asking, is this stock cheap or is this company growing, you ask, how good is this business at deploying capital to create profit? This is a much harder question. It requires more work. You have to look at the balance sheet and the income statement and do a calculation. It's not a number that's typically flashed on the screen on CNBC. Because it's more difficult, most people don't do it. They stick to their simple anchors. This creates a massive opportunity for the disciplined investor who is willing to do the work. By forcing yourself to anchor your analysis on the quality of the business as measured by its ROIC, you fundamentally change the game. You stop playing the market's game of chasing simplistic signals and start playing the owner's game of identifying superior economic engines. This mental discipline is what separates a speculator from an investor. A speculator is anchored to the stock price and its recent momentum. An investor is anchored to the underlying business and its long-term ability to generate cash returns on the capital entrusted to it. Breaking free from the market's simplistic anchors and adopting the owner's yardstick is a revolutionary act of independent financial thought. So, how do we put this into practice? We need a blueprint for calculating and interpreting this crucial metric. Let's create a simplified guide to calculating and interpreting ROIC. Step 1 is to find the numerator, net operating profit after tax, or NOPAT. This sounds complicated, but it's straightforward. You start with the company's operating profit, also called EBIT, from the income statement. This is the profit from the core business before interest and taxes are paid. Then you multiply it by 1, the company's tax rate. For example, if a company has an operating profit of $100 million and a tax rate of 25%, its NOPAT is $75 million. The reason we use NOPAT is that it shows us the company's profitability independent of how it is financed, i.e., with debt or equity. It is the pure, unlevered profit from the operations. Step 2 is to find the denominator, invested capital. This represents the total amount of money that has been put into the business by both shareholders and lenders to fund the company's net operating assets. The simplest way to calculate it is to go to the balance sheet and add together total equity and total debt, and then subtract any cash that is not essential for operations, often called excess cash. For instance, if a company has $400 million in equity and $100 million in debt, its invested capital is $500 million. This is the pool of capital that management is responsible for generating a return on. Step 3 is the calculation itself. ROIC equals NOPAT/invested capital. Using our examples, that would be $75 million in NOPAT divided by $500 million in invested capital, which gives us an ROIC of 15%. This number, 15%, is the owner's yardstick. It tells us that for every dollar of capital tied up in the business, the company generates 15 cents of profit each year. Step 4, and this is critical for any investment strategy, is interpretation. Is 15% good? To answer that, you have to compare it to the company's cost of capital. The cost of capital is the blended rate the company pays for its financing. A simple proxy is that for most established companies, the cost of capital is somewhere between 7% and 10%. The rule is simple. If a company's ROIC is consistently and significantly higher than its cost of capital, it is creating value. Every time it reinvests a dollar of profit back into the business, it is creating more than a dollar of value for its shareholders. If its ROIC is below its cost of capital, it is destroying value. It would be better off liquidating the business and returning the money to its shareholders. A business with a durable ROIC of 20% or more is a truly wonderful business. A business with an ROIC of 5% is a terrible one, no matter how fast its revenues are growing. This blueprint gives you a powerful lens through which to view any business, allowing you to quickly separate the economic superstars from the capital-destroying mediocrities. The antithesis of this disciplined approach is a common and destructive path taken by many corporate leaders and cheered on by unwitting investors. It's the path of diversification. This term, famously coined by investor Peter Lynch, describes the tendency of companies to grow by acquiring businesses in unrelated fields, often with poor returns, simply for the sake of getting bigger. It is the corporate embodiment of ignoring the owner's yardstick. Let's paint a picture of how this happens. Imagine a company, Corco, that has a fantastic core business. It has a great brand, high margins, and generates a 25% return on capital. It's a cash machine, just like See's Candies. But it operates in a mature industry, and its growth opportunities are limited. The CEO, driven by ego and a desire to see the company's name in the headlines, becomes impatient. Wall Street is clamoring for a growth story, so instead of returning the excess cash to shareholders via dividends or buybacks, the CEO decides to go on an acquisition spree. He buys a struggling manufacturing company in a completely different industry because it was cheap. The return on capital in this new business is 6%. Then he buys a trendy but unprofitable tech startup, hoping to catch the next wave. its return on capital is negative. After a few years of this, Corco is a much larger company. Its revenues have tripled. The CEO is on the cover of business magazines, lauded for his bold, transformative vision. But what has happened to the quality of the business? The company is now a clumsy conglomerate, a mishmash of a fantastic core business, and several mediocre to terrible ones. The overall return on capital for the combined company has plummeted from 25% down to 8%. The company has grown, but it has become a worse business. It has diversified. It has destroyed shareholder value by taking the profits from a great business and reinvesting them at terrible rates of return. The 99% investor, looking only at the rising revenue line, cheers this on. The disciplined investor, the one using the owner's yardstick, sees this for what it is, a tragedy. They see a beautiful economic engine being diluted with sand and mud. A historical example is the fall of many great industrial conglomerates of the 20th century, which grew into massive, unfocused behemoths that ultimately had to be broken up to unlock their value. This path of growth for growth's sake is a direct rejection of the ROIC principle. It serves the egos of management, not the wallets of the owners. The direct financial connection between focusing on ROIC and building your wealth is profound and mathematical. It links the income statement profit directly to the balance sheet, capital invested, and tells you the fundamental efficiency of a business. This efficiency is the single most important determinant of a company's ability to create long-term value. Let's consider two companies, Company A and Company B. Both have $1 billion of invested capital. Company A has a sustainable ROIC of 20%, meaning it generates $200 million in NOPAT each year. Company B is in a tougher industry and has an ROIC of 5%, generating $50 million in NOPAT. Now, let's assume both companies retain half of their earnings to reinvest for growth. Company A reinvests $100 million. Because it can deploy that capital at its excellent 20% ROIC, that $100 million investment will generate an additional $20 million in profit the following year. Its earnings will grow organically at a rapid clip. Company B reinvests $25 million. But because it can only earn its paltry 5% ROIC, that investment will only generate an additional $1.25 million in profit. To achieve the same $20 million in profit growth as Company A, Company B would need to invest a staggering $400 million. It's clear which company is the superior wealth-building machine. This concept is the engine of compounding. A company that can consistently reinvest capital at a high rate of return is a true compounder. The value of your investment in such a company will grow exponentially over time, not just because the stock price goes up, but because the underlying value of the business itself is compounding at a high rate. Albert Einstein is reputed to have called compound interest the eighth wonder of the world. High ROIC businesses are the physical embodiment of that wonder in the corporate world. When you build a portfolio of these high-return businesses, you are harnessing the most powerful force in finance for your own wealth building. Your portfolio growth becomes driven by the fundamental economics of the businesses you own, not by the fickle whims of market sentiment. You are tying your financial future to the mathematical certainty of high-return capital allocation. This is the ultimate goal of value investing and the most direct and powerful financial connection there is. It's how Buffett transformed a small pile of capital into the empire of Berkshire Hathaway by relentlessly focusing on the owner's yardstick. We have now established a powerful set of defensive tools. We know to be wary of capital-hungry growth, to look past the siren song of revenue, and to use return on capital as our ultimate yardstick of business quality. But this leads to a critical question. What allows a great business like See's Candies to maintain a high return on capital year after year? Why aren't its profits competed away by rivals, as they were in the textile or airline industries? The answer lies in a concept that is the very cornerstone of Warren Buffett's entire investment philosophy. It is the great protector of high returns, the shield against the brutal forces of competition. This brings us to our fourth pillar, the economic moat, your shield against value-destroying growth. An economic moat, a term popularized by Buffett, is a durable competitive advantage that allows a business to protect its profitability and market share from attack, much like a medieval castle's moat protected it from invaders. It is the structural feature of a business that allows it to fend off competition and earn high returns on capital for extended periods. A business without a moat, no matter how profitable it may be today, is a castle built on sand, vulnerable to the relentless tide of competition. A business with a wide, sustainable moat is a fortress, capable of defending its profits and compounding its owners' capital for decades. One of the most dramatic stories from Buffett's career that illustrates the power of a moat is the saga of American Express and the salad oil scandal of 1963. American Express in the early 1960s was a great business with two primary moats. First, it had a powerful brand that was synonymous with trust and financial security, particularly through its travelers' checks. Second, it had a growing network effect in its charge card business. The more merchants that accepted the card, the more valuable it became for cardholders, and the more cardholders it had, the more essential it became for merchants to accept it. But in late 1963, disaster struck. A small subsidiary of American Express had made large loans to a company called Allied Crude Vegetable Oil Refining, run by a man named Tino DeAngelis. The loans were secured by the company's inventory of salad oil, which was stored in massive tanks in New Jersey. It was discovered that DeAngelis was a fraud. Most of the tanks were filled with water, with only a thin layer of oil floating on top. Allied Crude went bankrupt, and American Express was on the hook for what was then a staggering sum of money, potentially over $175 million. Wall Street panicked. The market assumed that this scandal would be a mortal blow. They believed that the losses would bankrupt the company, and, more importantly, that the reputational damage would shatter the trust that was the bedrock of its business. Investors feared that people would stop using American Express travelers' checks and that merchants would stop accepting its cards. The stock price was decimated, plunging by nearly 50% in a matter of weeks. It was a classic case of Mr. Market overreacting to terrifying but short-term news. This is where Buffett's genius came into play. Instead of panicking with the crowd, he decided to do his own due diligence. He went out and observed the business firsthand. He visited restaurants and travel agencies. He talked to merchants and customers. And what he found was that the company's economic moat was completely intact. Customers were still confidently buying and using travelers' checks. Businessmen were still taking clients out to dinner and paying with their American Express cards. The scandal, while a painful financial hit, had not damaged the core relationship the company had with its customers. The brand's power and the network's utility were proving to be far more resilient than the market believed. Convinced that the fundamental business was unharmed and that its long-term earning power was secure, Buffett made a bold move. He invested 40% of his partnership's capital into American Express stock, making it his single largest investment. His bet was not on the company's short-term earnings, it was on the durability of its economic moat. His conviction was rewarded handsomely. The company weathered the financial storm, the scandal eventually faded from the headlines, and the underlying business continued to grow and prosper. Within a few years, the stock price had recovered and soared to new highs, earning Buffett's partnership a massive profit. This story is the perfect illustration of a moat in action. It is the moat that provides the resilience. It is the moat that protects the long-term earning power of a business from shocks and crises. And it is the ability to identify and value that moat that allows a great investor to act decisively when others are paralyzed by fear. A company with a strong moat can survive mistakes and bad luck, while a company without one can be destroyed by the slightest headwind. The reason most investors fail to properly appreciate the importance of moats is because of a cognitive trap known as confirmation bias. This is our tendency to search for, interpret, favor, and recall information in a way that confirms or supports our pre-existing beliefs or hypotheses. Once we label a stock as a growth stock, our brain actively seeks out evidence to support that label. We look for rising revenues, positive press releases, and bullish analyst reports. At the same time, we subconsciously ignore or downplay disconfirming evidence, such as new competitive threats, eroding market share, or declining margins. We fall in love with our own story about the company's bright future and filter out anything that contradicts it. The mental model of the economic moat is a powerful antidote to confirmation bias because it actively forces you to look for the opposite. The very process of analyzing a moat requires you to play devil's advocate. It forces you to ask the tough, skeptical questions. What could destroy this business? Who are the competitors, and what are they doing? How sustainable are these high profits? Why can't someone else come in and do the same thing, but cheaper? This shift in questioning is profound. It changes your research process from one of cheerleading to one of critical examination. Instead of just looking for reasons to buy, you start by looking for reasons not to buy. You adopt a paranoid mindset, constantly scanning the horizon for invaders trying to breach the castle walls. This discipline of actively seeking out disconfirming evidence is one of the key traits that separates great thinkers and investors from the masses. Charlie Munger calls it inverting the problem. Instead of asking how a company can succeed, he asks what could cause it to fail. If you can't find a plausible scenario for failure due to competition, you may have found a business with a durable moat. By making the search for a moat a non-negotiable part of your investment process, you are hardwiring a defense against your own confirmation bias. You are forcing yourself to confront the risks and threats head-on, leading to a much more robust and realistic assessment of any potential investment. To make this practical, we need a blueprint for identifying these competitive advantages. Let's create the Moat Identification Checklist, which covers the 4 primary sources of economic moats that Buffett and Munger look for. First, intangible assets. This includes things like brands, patents, and regulatory licenses. A powerful brand, like Coca-Cola's, allows a company to charge a premium price for a product that is otherwise a simple commodity. Ask yourself, can this company charge more than its rivals for a similar product? Do customers ask for it by name? Patents can provide a temporary monopoly, and licenses, like a license to operate a landfill or a television station, can legally bar competition. Second, switching costs. This is when it is expensive, time-consuming, or otherwise painful for a customer to switch from one provider's product to another's. Think about the software that your company uses. The cost of retraining every employee on a new system and migrating all the data is so high that the company will stick with its current provider even if a slightly better or cheaper alternative comes along. Ask yourself, how difficult would it be for this company's customers to fire them and hire someone else? Is there a significant risk or cost involved in switching? Third, the network effect. This is a powerful moat that exists when a product or service becomes more valuable as more people use it. The classic examples are credit card networks like Visa and American Express, or social media platforms like Facebook. Every new user on Facebook makes the platform more valuable for all the other users. The first person with a telephone had no one to call. The billionth person has a vast network to connect with. Ask yourself, does this business benefit from a winner-take-all dynamic? Does its value increase exponentially with its user base? Fourth, cost advantages. This is the ability to produce a product or service at a lower cost than competitors, allowing the company to either undercut rivals on price or to earn higher profit margins. This can come from superior scale, like Walmart's massive purchasing power, or from a superior process, like Geico's direct-to-consumer insurance model, which bypasses costly agents. Ask yourself, does this company have a structural cost advantage that competitors cannot replicate? Can it consistently be the low-cost provider in its industry? By systematically going through this checklist and asking these tough questions for any company you analyze, you can begin to identify the presence and strength of an economic moat. A company that ticks one or more of these boxes with a strong yes is a candidate for a deep dive analysis. A company that has none is likely a castle built on sand, no matter how good its recent performance has been. The antithesis of investing in moated businesses is the common but disastrous strategy of investing in commodity businesses that are caught on a capital-intensive treadmill. This is the path of the 99% investor who gets lured in by cyclical upturns without understanding the underlying lack of competitive advantage. Let's consider a generic memory chip manufacturer, Chipco. The memory chip industry is a classic commodity business. The chips made by one company are largely indistinguishable from those made by another. The only thing that matters to customers, like computer manufacturers, is price. There is no brand loyalty or switching cost. This creates a brutal competitive environment. When demand for computers is high, all the chip companies make a lot of money. Their revenues soar, their profits look great, and their stock prices go through the roof. The 99% investor sees this and piles in, believing they've found a fantastic growth stock. But the high profits inevitably attract competition. Seeing the success of Chipco, other companies invest billions of dollars to build new fabrication plants. Soon, the market is flooded with new supply. A massive price war erupts as all the manufacturers slash prices to try and sell their inventory. The industry's profits evaporate overnight. The stock prices of all the companies in the sector collapse. Chipco, which looked like a genius company during the boom, is now fighting for survival. This boom and bust cycle is the hallmark of a no-moat, commodity industry. The companies are on a perpetual treadmill. They have to constantly spend billions of dollars on new, state-of-the-art factories just to keep up with the technology, high capital intensity. But any profits they make during the good times are inevitably competed away in the bad times. There is no durable advantage that allows them to protect their returns. The 99% investor buys at the top of the cycle, seduced by the temporary high profits, and then gets wiped out in the inevitable downturn. The disciplined, moat-focused investor understands the structure of the industry and avoids it altogether, knowing that it is a graveyard for capital over the long term. They recognize that any growth in such an industry is likely to be value destructive, as it requires massive capital investment for a fleeting and unreliable return. The direct financial connection between an economic moat and your portfolio is one of the most important concepts in all of finance. A moat is directly visible on a company's financial statements through the sustainability and level of its key profitability metrics. It is the hidden cause behind the beautiful financial effects. A company with a wide moat will exhibit consistently high returns on invested capital, year after year, decade after decade. A no-moat company will see its ROIC swing wildly, soaring during industry booms and plummeting during busts. A moat also shows up in high and stable gross margins. A company with a strong brand or high switching costs can maintain its pricing power even when its own costs go up, protecting its profitability. A commodity company has to absorb cost increases or risk losing all of its business. Furthermore, a moated business often generates far more free cash flow. Because it doesn't have to constantly fight off competitors, it can spend less on frantic, defensive capital expenditures and marketing, allowing more of its operating cash to fall to the bottom line for shareholders. When you build a portfolio of businesses with wide, durable economic moats, you are building a portfolio with inherent resilience. It will be less volatile because the earnings of the underlying companies are more predictable and less susceptible to the storms of competition. More importantly, it will have a much higher probability of compounding your wealth over the long term. The moat is what allows the magic of compounding to work. It protects the high returns on capital that, as we saw in the previous pillar, are the fundamental engine of value creation. Without a moat, high returns are temporary, and long-term compounding is impossible. By making the identification of a durable economic moat a cornerstone of your stock-picking process, you are tilting the odds of long-term success dramatically in your favor. You are moving beyond simply analyzing what a company is doing today and focusing on the structural reasons why it will still be a great business 10-20 years from now. This is the essence of true long-term investing and the ultimate key to building lasting financial security. We have now constructed a formidable fortress of investment knowledge. We know to avoid capital-hungry growth, to see through the illusion of revenue, to measure with the owner's yardstick of ROIC, and to demand a protective economic moat. But even a perfect business, a wonderful castle with the widest of moats, can be a terrible investment if you pay too much for it. This brings us to the final, critical pillar that ties everything together. It is the discipline that separates the professional from the speculator, the act of prudence that ensures your hard-won analytical insights translate into actual profits. This is our fifth pillar, paying for the future, the discipline of valuing, not chasing, growth. The greatest business in the world, bought at an infinitely high price, guarantees a return of zero. Your ultimate return as an investor is not determined by the quality of the business alone. It is determined by the relationship between that quality and the price you pay to own it. Chasing after popular, fast-growing stocks without regard to valuation is a surefire way to achieve mediocre or even disastrous results, even if you correctly identify wonderful companies. The foundational anecdote for this pillar is one of Buffett's most famous and brilliant investments, his purchase of Coca-Cola in 1988. By the late 1980s, Coca-Cola was already one of the most dominant and well-known companies in the world. It had a global brand that was arguably the most powerful intangible asset on the planet. Its business model was capital light and gushed free cash flow. It had a massive economic moat. However, the stock market crash of October 1987, Black Monday, had shaken investor confidence. In the aftermath, even the highest quality stocks were trading at prices that were far more reasonable than they had been just a year earlier. While many investors were still paralyzed by fear, Buffett saw an opportunity. He began to meticulously analyze Coca-Cola not as a blip on a stock screen, but as a business he might own in its entirety. He read the annual reports going back decades. He thought about the company's future. He saw that while Coke was already huge in the United States, its per capita consumption in the rest of the world was a tiny fraction of what it was domestically. He envisioned a future where billions of people in developing countries would, as their incomes rose, reach for a Coke. He saw a massive, untapped runway for profitable growth that the market was underappreciating. But his analysis didn't stop with the qualitative story. He then turned to the numbers. In 1988, Coca-Cola was generating about $1 billion in pre-tax earnings. The total market value of the company was around $14 billion. To Buffett, this valuation seemed incredibly cheap for a business of such quality and with such clear global growth prospects. He saw a business that could reliably grow its earnings at a healthy clip for decades to come, and he was being asked to pay a price that didn't fully reflect that future. So, over a period of several months in 1988, Berkshire Hathaway invested over $1 billion to acquire a significant stake in the Coca-Cola Company. It was, at the time, a massive bet for Berkshire. Many on Wall Street were skeptical. They saw Coke as a mature, boring company and thought Buffett was overpaying for a slow grower. They were anchored to the idea that exciting returns could only come from fast-growing technology companies. Buffett's decision was a masterclass in the final pillar. He had identified a wonderful business, high ROIC, wide moat. He had identified a long runway for profitable growth. And, crucially, he waited for a moment when he could buy that business at a price that offered what he famously calls a, quote, margin of safety. He was not chasing the stock after a huge run-up. He was buying it methodically after a market panic, when the price was reasonable relative to its future prospects. The results speak for themselves. The $1 billion investment is today worth well over $20 billion. And that's not including the tens of billions in dividends Berkshire has received over the decades. The Coca-Cola investment demonstrates the power of combining business analysis with valuation discipline. It's not enough to find a great company. You must have the patience and the fortitude to buy it only when the price makes sense. As Buffett himself has said, quote, for the investor, a too high purchase price for the stock of an excellent company can undo the effects of a subsequent decade of favorable business developments. The psychological force that drives us to break this final crucial rule is perhaps the most powerful and primitive of all investment emotions: the fear of missing out, or FOMO. This is the anxiety that an exciting opportunity is passing you by, and that others are profiting while you are stuck on the sidelines. FOMO is the engine of all speculative bubbles. When we see a stock price going up day after day, when we hear stories of people getting rich quick, our rational, analytical brain is hijacked by our emotional, impulsive brain. The desire not to be left behind becomes an overwhelming urge. This emotional response is a relic of our evolutionary past. In a tribal environment, being excluded from a hunt or a resource discovery could be a death sentence. We are hardwired to want to be part of the group, to participate in what everyone else is doing. In the modern world of investing, this instinct is deadly. It causes us to buy high, at the peak of excitement and euphoria, and to sell low in the depths of panic and despair. The discipline of valuation is the rational antidote to the emotional poison of FOMO. Valuation is the act of calculating, based on conservative assumptions, what a business is truly worth, independent of its current, fluctuating stock price. By having a firm estimate of a company's intrinsic value in your mind, you create a logical anchor that can keep you grounded when the emotional tides of the market are raging. If your analysis tells you a hot growth stock is worth $50 a share, and the market is currently trading it at $150, you can calmly stand aside, immune to the FOMO. You know that buying at that price offers no margin of safety and a high probability of poor future returns. Conversely, if a great business you value at $100 a share gets caught in a market panic and falls to $60, you can act with conviction and courage, knowing you are buying at a significant discount to its true worth. Valuation transforms you from a price taker, buffeted by the whims of the crowd, into a value provider, a business person who calmly assesses opportunities and acts only when the price is right. It is the final and most important shield against the self-destructive impulses that FOMO creates within all of us. So how can a retail investor, without a team of analysts, apply this discipline? We need a simple, common-sense valuation blueprint. Let's call it the "what do I have to believe" valuation method. This approach sidesteps complex spreadsheet models and gets right to the heart of the matter. Step 1. Look up the company's current stock price and multiply it by the number of shares outstanding to get its market capitalization. This is what the market believes the entire company is worth today. For example, a company with a market cap of $10 billion. Step 2. Look up the company's free cash flow for the most recent year. Let's say it's $300 million. Step 3, and this is the core of the method, ask the critical question. Based on today's $10 billion price tag, what rate of growth in free cash flow for how many years do I have to believe in to justify this price? You are essentially working backward from the price to see what expectations are already baked into it. You don't need a precise calculator for this. You can use common sense and back-of-the-envelope math. Does the current price imply that the company must grow its cash flow by 30% a year for the next 10 years? Step 4. Compare that implied growth rate to reality. Is this a realistic expectation? Has the company ever grown that fast before? Is the industry it operates in large enough to even support that kind of sustained growth? Is its competitive position strong enough to maintain the margins required to produce that cash flow? If the implied growth rate seems heroic, absurd, or borderline impossible, then the stock is likely overvalued. You would have to believe in a perfect fairy tale future to make money buying at today's price. If, on the other hand, the implied growth rate seems very conservative, say, the price only implies 5% growth for a company that has historically grown at 15% and has clear avenues to continue doing so, then the stock may be undervalued. This mental model doesn't give you a precise target price, but it does something far more important. It frames valuation as a question of probabilities and common sense. It protects you from buying into hype by forcing you to confront the future reality that must unfold for your investment to be successful. It is a powerful tool for risk management, and for avoiding the market's most overpriced darlings. To see the devastating consequences of ignoring valuation, we only need to look at the antithesis, the historical cautionary tale of the Nifty 50 era in the early 1970s. The Nifty 50 were a group of about 50 large-cap blue-chip stocks on the New York Stock Exchange that were seen as quintessential buy-and-hold investments. Companies like Xerox, Polaroid, IBM, and McDonald's. They were, by all accounts, wonderful businesses. They dominated their industries, had strong growth prospects, and were seen as so reliable that you could buy them at any price and hold them forever. They were one-decision stocks. The only decision you had to make was to buy. This belief became a self-fulfilling prophecy for a time. Institutional investors piled into these same 50 stocks, driving their valuations to astronomical levels. It was not uncommon for a Nifty 50 stock to trade at a P/E ratio of 50, 80, or in the case of Polaroid, even over 90. The logic was that their growth was so certain and so rapid that no price was too high. The discipline of valuation was thrown out the window, replaced by the mania of chasing quality at any cost. Then came the brutal bear market of 1973-1974. The economy soured, inflation spiked, and the market crashed. And the Nifty 50, these supposedly safe stocks, were utterly crushed. Xerox fell from a high of $170 to just $28. Polaroid collapsed from $143 to a mere $14. An investor who had bought a portfolio of these stocks at the peak in 1972 saw the value of their holdings decline by 70% or more. But here is the most important part of the lesson. The businesses themselves actually performed quite well over the next decade. Their earnings and sales continued to grow. The problem was not the businesses. The problem was the insane price that investors had paid for them. The starting valuation was so high that even a decade of solid business growth was not enough to produce a decent return for the shareholders who bought at the top. Many of these stocks took more than 10 years just to get back to the price levels of 1972. The Nifty 50 is the ultimate proof that even the best companies can be terrible investments if the price is wrong. It is the historical monument to the folly of chasing growth and quality without the discipline of valuation. It is the path of the 99%, a path paved with good companies and terrible returns. The direct financial connection between valuation discipline and your own financial success is the most straightforward of all. The price you pay for an asset is the single greatest determinant of your future rate of return. This isn't just a stock market concept, it's true for real estate, art, or any other investment. Let's make it concrete. Imagine a great business that you've analyzed. You believe its intrinsic value will grow from $100 a share today to $200 a share in 5 years. If you are disciplined and wait until you can buy that stock for $80 a share, your potential return over those 5 years is 150%, a gain of $120 on an $80 investment. Now, imagine you get caught up in FOMO and chase the stock up to $160 a share. Even though you own the exact same business, with the exact same future prospects, your potential return is now only 25%, a gain of $40 on a $160 investment. Same company, same future, but a dramatically different outcome for you, the investor. The difference was determined entirely on your purchase day. This concept manifests in your portfolio through the powerful force of P/E compression or expansion. When you buy a stock at a very high P/E ratio, the Nifty 50 mistake, you face the headwind of P/E compression. Even if the company's earnings, the E, grow nicely, if the market decides to award the stock a lower P/E multiple in the future, your returns will be muted or even negative. Conversely, when you buy a good business at a low P/E ratio, you get a potential double tailwind. You benefit from the growth in earnings, and you can get an additional boost if the market re-rates the stock to a higher P/E multiple in the future. This is how many of the greatest value investors have made their fortunes, by buying good businesses when they are temporarily out of favor and priced at a low multiple, and then benefiting from both the business's fundamental growth and the market's eventual recognition of its quality. Your personal wealth building is inextricably linked to this discipline. Every dollar you save, by refusing to overpay, is a dollar that increases your margin of safety and boosts your potential future return. Mastering valuation is the final step in becoming a true business analyst. It ensures that all your hard work in analyzing capital intensity, profitability, and competitive moats is not squandered by the simple, amateurish mistake of paying too much. You have just spent this time rewiring the very foundation of how you analyze investments. You have installed a powerful new filter in your mind, a shield against the most seductive and destructive lies that Wall Street tells. You no longer see growth as a simple number on a screen. You see the hidden engine beneath it, an engine that can either create value or consume it. You no longer hear the siren song of revenue as a call to action, but as a potential warning sign, prompting you to cross the profitability bridge. You have discarded the market's flimsy yardsticks and have adopted the perspective of an owner, measuring every opportunity with the unwavering standard of return on invested capital. You have learned to see the invisible fortresses, the economic moats, that protect great businesses, and you understand that the final act of genius is not just in finding the fortress, but in having the discipline to buy it only when the price is right. This is not a small thing. This is a complete mental arsenal, a set of tools that the 99% of investors will never possess. But understanding this system of defense, this way of avoiding the market's biggest traps, is only the first half of the equation. Warren Buffett's true genius lies not just in what he avoids, but in what he actively seeks. The system you have just learned is part of a larger, interconnected network of mental models. How does he find the rare companies that possess these wonderful characteristics in the first place? What specific qualities does he look for in the management teams entrusted to allocate the capital of these great businesses? How does he think about the broader economic environment and the psychological temperament required to act when others are frozen in fear or drunk with greed? Mastering the growth trap is the essential shield, but you still need the sword. The principles of identifying exceptional leadership, of understanding the circle of competence, of thinking in terms of probabilities, these are the offensive weapons that complete the arsenal. The video that is now appearing on your screen is not a random suggestion from an algorithm. It is the next piece of the map. It is the critical link that connects the defensive principles you have just mastered with the offensive strategies that build legendary fortunes. It is the bridge from how not to lose to how to win big. You have proven just by reaching this point that you are not part of the 99%. You are not a speculator chasing headlines. You are an analyst. You are an owner in training. The only question that remains is how far you are willing to go. Will you settle for the shield, or will you claim the sword as well? The journey to complete your financial education, to acquire the full mental arsenal of the world's greatest investor, continues with your very next click. That next video holds the missing link. Click and continue your ascent.